Welcome once again. This is the third in a series of videos about how to undertake a self-directed investment program. The lesson of this video is simple. There's no perfect or best time to buy shares. This is important for you to remember. Write this down in your notes, put it on a sticky note, place it where you'll see it every morning. The reason is simple. Often, when you buy some shares, it will seem that you've made an error. This is especially true when you are starting out on this path. You will suffer buyer's remorse, and there is no getting around this. If the share price goes down, you'll think, if only I had waited. If the price goes up, you'll think, if only I had bought this 6, 8, 12, 10 months ago. This is human nature. We all second guess our choices, but in investing, this can paralyze you. Many novice investors fall into this mental trap of woulda, coulda, shoulda, is what I like to call it, and they never advance to become the successful investors they could have been. So don't do that. Do not second guess yourself. Many folks embrace a fantasy of being a day trader, sitting at a computer with a cell phone in one hand and a quadruple espresso in the other, constantly buying and selling shares from the opening to the closing of the market, and constantly making a profit because you're able to recognize the best time to get in and the best time to get out. Alas, this image is a fantasy. Oh sure, there are people who do this and do it successfully, but they are very few and very far between, and even they suffer losses at the ends of most trading days. It's just that the successful ones suffer less serious losses. This is just the nature of day trading. A typical investor, who has life outside of investing, will do far, far better following an established investment plan and riding out any small fluctuations in the market rather than trying to capitalize on them as most day traders do. Let this be your goal. Methodical long-term investor, not that frenetic, over-caffeinated day trader. The technique of making an investment that will work for you is simple, and it is fully explained in these videos. These videos will help you learn how to research companies, how to read and interpret financial statements, how to go about making the best decisions, and how to maximize the yield from your investments. Armed with this knowledge, it is your job to make decisions that are right for you. Once you do make your decision, resist the temptation to second-guess yourself. You will have a plan, you will have done your research, and you will have a thoughtful decision that is made. Have confidence in yourself. You'll be all right because the knowledge you gain from these videos will prepare you for sound investing. Another fantasy is discovering another Microsoft or IBM, when it is a little company no one else has discovered. That's a nice dream, but it's a novice investor's fantasy. There are cases of people buying into IBM in the early 50s with an investment of $10,000 and ending that decade as multimillionaires. It happens. It is, of course, rare. Do not pursue the fantasy. Most successful investors evolve and grow their gains over a long term, following sound principles and using discipline. You've probably heard it said, buy low and sell high. That sounds good, but it's not very actionable. Here's something that is. Watch the crowd. When it seems all believe the market is as low as it can go, it's probably time to buy in. The market will usually continue lower, and you may regret the money you lose in the short term, but stay calm. It will turn. Similarly, when everyone says the market cannot go any higher, it's probably time to sell and step out. Again, the market may go higher, and you may regret a few extra dollars that you could have made in the short term. Relax. You're in this game for long-term gains. The market is not a Swiss watch. You're not going to catch the ups and downs perfectly. Think in terms of it being a long-term process because it is a long-term process. If you can master that viewpoint, you will be pleased with the long-term outcome. It gets back to discipline and patience. There is no magic moment when it is best to either buy or sell your shares. Let's take a hypothetical situation. You're thinking about investing in Company X. They've been in business for over 50 years. They had a rocky first few years, as many companies do, but now they have come to dominate their market segment nationwide in a business producing something that everyone uses and must purchase with some regularity. Now, Company X's balance sheet looked great. You'll soon learn how to read a company's balance sheet. These videos will guide you in that learning. With study, you observe there are no significant liabilities against the company. Management is great, distribution channels are all great. In short, all is well with Company X's world. You'll also notice that Company X's shares sell steadily in the $55 to $60 range. Having done your research, you've concluded Company X would be a good addition to your investment holdings. You go online and check the current share price. it's still in the $55 to $60 range, so you proceed to purchase 200 shares. You now own a fraction of Company X. You now own something real and tangible. This is not like buying a Powerball ticket you'll probably end up throwing away in a few days after you don't win. At the same time, you cannot get emotionally attached to it. You will receive the dividends, if any, paid on one share of Company X times 200. You'll receive a dividend check for that amount for as long as Company X pays dividends and as long as you hold the shares. And of course, you own the stock. Company X could make a great breakthrough in its stodgy conservative field, and share prices could climb dramatically. Or some other entity could have its predatory eye on Company X and make a bid for its shares that is well above the market price. There are all kinds of ways you can make money with 200 shares. Just remember to stick to your plan. Suppose another company comes along and offers $80 a share and a bidding frenzy breaks out. Suddenly your Company X shares are selling for $120 a pop. Be thankful for your good fortune and get out. This sort of thing does happen. Stay alert. If it should happen to you, happily sell your shares and take your winnings. We'll discuss in more detail how this sort of happy event occurs. For now, let's just say that this happy event was pure luck. You did demonstrate skill and thoughtful analysis to identify Company X as a solid investment opportunity within your plan. Your skill is of pivotal importance to your success as an investor, and when others recognize the same fundamentals, you can capitalize on it, assuming you got there early on. This scenario does illustrate when it is a good idea to sell. At times, opportunities like this do materialize, infrequent though they are, and they do not last long, so stay alert and attentive to your investments. If something like this scenario does come along, it is always a very good idea to gather your profits and leave Company X behind. Remember, there are always opportunities to invest. More will come along. The art is in finding the good opportunities, the opportunities that are right for you and your plan. Following a disciplined long-term approach is the path to success. I repeat, the disciplined long-term approach is the path to success. Back to our Company X example, you learned that Company X's shares typically trade in the $55 to $60 range. There are times when the market as a whole loses interest in a corporation or even a market segment. Although Company X is fundamentally sound, and it is a fundamentally sound company, and everything is in order within its management and balance sheet, there are times when the crowd just loses interest in otherwise good companies. This, of course, causes Company X's shares to drop in price. This may not be a bad thing. It may present a buying opportunity for you. Naturally, if Company X's share price drops to, say, $40, it's a definite buy. But when does it become such a buy? Again, you have to determine just how much risk you are willing to tolerate. Suppose you've concluded from your study that Company X has a fundamental value of $50 a share. In other words, if you owned Company X in its entirety and you sold it at a fair price, you would get the cash equivalent of $50 a share, which is probably not far off for a share typically selling in the $55 to $60 range. Several things, such as short-term dividends, brand name value, goodwill, and all the other intangibles that can result in this sort of $5 to $10 difference. You may see cases where a company has the equivalent of 112 in cash on hand plus all their other assets, yet their shares are selling for $70. Clearly, such a company is a buy. Eventually, people will discover the company's true value and the share prices will climb to reach that number. On the other hand, you may see companies teetering on the brink of ruin, with hardly any cash on hand. No new products in the pipeline so far, and too many liabilities, and their shares are selling for $80. If you happen to find yourself holding these shares, it's a good idea for you to sell them. Opportunities like these do exist, and you will learn how to spot them. As you might expect, these are unusual situations. In strongly growing markets, there are few buying opportunities like this, but do be alert for a selling opportunity where the inflated market has carried a share price beyond its reasonable value. In time, you'll learn how to do this without even owning the underlying shares. We want you to understand how you maximize your gains and minimize your losses. That's obviously very important. Keep in mind, everyone you included will experience losses. Successful investors manage to minimize their losses, and that can make all the difference in the long run. Keep in mind that there are day traders and people interested in short-term profits that will take their money and run. As a dedicated investor with a plan, you are in this for the long term. You're in this for the dividends you'll collect and the gains you make in that long term. If you've chosen well in accordance with your plan, you've stacked the odds of success in your favor. Just be aware that all stock prices eventually tend towards their book value. So, what is it that determines the price of a share of a stock? Stock prices change every day because of supply and demand. So what do we mean by that? Demand and supply are terms that are used to indicate the balance of investor sentiment in buying versus selling that stock. If there is a greater demand, investor interest, in buying the stock than in selling it, that the demand is said to exceed supply, and that greater demand drives the price upwards. Conversely, if there is more interest in selling the stock than buying it, supply is said to exceed demand and the price declines. A conceptual understanding supply and demand is straightforward. However, understanding why demand and supply shift is more challenging. Why do people prefer one stock over another? Why do they shift and at times demonstrate a growing willingness to buy and pay more for a company's given stock is more complicated. There are many reasons, of course. One is interpreting for any one company what news is positive and what news is negative. The reality is that a stock's price and price movement reflects what investors feel a company is worth at any one time. Incidentally, do not confuse a company's value with its stock price. The value of a company is the value of all of its shares, the number of shares times its stock price. This is called the company's market capitalization. To fully understand a company's value, determine its market capitalization. You don't have to do the calculation. It is readily available on websites such as Yahoo Finance. This can be compared from one company to the next. Thus, value is determined by number of shares and the share price. It is not the share price alone. Additionally, the price of a stock also reflects the growth that investors expect in the future. Expectations for the future are very important in the world of investing. One might say it is all that is important in the world of investing. The most important factor that affects the value of a company is the profit it makes. This is referred to as the company's earnings. At times, earnings are depressed while the company gets established, or when it invests heavily to support future growth. Thus, sometimes low earnings can be an acceptable event and not indicate negative news. Obviously, at some point, earnings do become essential for survival, but in the short term, they can be considered an investment in the future. Most companies, certainly all publicly held companies, are required to report their earnings every 3 months for each calendar quarter. All Wall Street watchers pay close attention to these earnings releases. Wall Street analysts use earnings and related news reports as the basis for projecting future earnings, which us small investors read with great interest. After all, these analysts focus their attention on companies and industry segments far more than we can. These analysts also compare the earnings reported by the company against what they had anticipated. If a company's results are better than Wall Street's expectations, the stock price will rise, and then conversely, if results disappoint, the stock price declines. So actual performance versus expectation is a key factor behind stock price movements. Of course, it's not just earnings that can change the sentiment towards a stock. Remember, expectations are critical. At the close of the 20th century, expectations were high for many young internet companies. Many of these companies saw their stock prices soar before making any profit whatsoever. Expectations. Once these lofty expectations dampened, share prices plummeted. That time period is now referred to as the dot-com bubble. It is an example of how factors and emotions other than current earnings influence stock prices, not the numbers, but rather the emotions. There's no easy answer to the question of why stock prices change. Some investors utilize technical charts, ratios, and other mathematical relationships to determine when to buy and when to sell. Some of these are well known, such as the price-to-earnings ratio, and others are not broadly known. One of the goals of these videos is to familiarize you with the many tools for analyzing stocks. Through watching and studying these videos, you can learn fundamental analysis and can develop and execute a plan of your own. Let's summarize some of the things we've covered during this video. Number 1. There is no perfect time to buy or sell a given stock. Your goal should not be about timing, but having an overall investment plan and choosing stocks that meet the criteria in that plan. Number 2. Investment success comes from a disciplined plan and process. Measure your success by your progress toward long-term goals. Number 3, supply and demand are the key determinants of stock price, and supply and demand are the products of investor sentiment on future earnings expectations. Number 4, the value of any company is its market capitalization, share price times the number of shares, in other words. Therefore, comparing the stock price between two separate companies is meaningless. Number 5, investors often value a company based on its earnings performance. However, expectations often override actual performance. Investor expectations and sentiments are the real drivers, and sometimes these sentiments turn into mass momentum, like the dot-com bubble. Remember what you heard about the effect of the crowd. The momentum that sometimes develops in the marketplace can inflate or depress stock prices without regard for true fundamental principles. Now, theories abound to explain stock market and its ebbs and flows, its fluctuations. There is no single formula that you can use to remove all uncertainty or assess a company's investment future, at least not yet. We tell you these things not to scare you, but just to point out that there's a lot of potential issues to consider and navigate through. Many people do this. The successful ones, like you, have done their homework. They have courses, they have lesson plans. Have a plan and the discipline to stick to it. I say this over and over and over. Have a plan and the discipline. We encourage you to think through your investment goals and develop a thoughtful investment plan. Resolve to do this and do it thoughtfully. Then resolve to remain disciplined and invest your money in keeping with your plan. This will save much heartache later. So, enjoy this and the previous videos. Do your homework, watch these videos again, be a thoughtful student, exercise your discipline, stick to your plan, do your homework, watch them again. Like I said, take notes. You will be much pleased that you did, I have no doubt.